let's get this party started. You guys ready? Yes, we could do it. Yes, we can. All right. So let's look at Unit 1. What this is addressing is what it means to be practicing before the IRS. Remember we talked about that in a prior meeting. What it means to be practicing before the IRS. And it's not something that's subject to interpretation. We know that if we want to determine what that means, we could look at Circular 230. And that's what we did. We were looking at Circular 230. And this scenario is seeing if we know what it means to be practicing before the IRS. So for review, let's look at the choices that we have here. All right, so we have 4 different choices. Keep in mind that in order for us to be practicing before the IRS, we need to be doing more than preparing a tax return. So that's what one of the choices suggests, is that we are preparing a tax return. But what are some of what are the 4 main criteria that define what it means to be practicing before the IRS? Remember we talked about this from Circular 230. So for example, if we're communicating with the IRS on behalf of the taxpayer regarding the taxpayer's liabilities and privileges under the tax code, so if we're communicating on behalf of the taxpayer in regard to their liability, so in other words, when you talk about liability, what does that mean? It means how much money they owe, how much tax they owe. Then that's an example of practicing before the IRS. So does that happen? Does that happen all the time? Who did we say, for example, usually practices before the IRS? A CPA, right? We said a CPA very often is practicing before the IRS. An attorney, right? A lawyer, an enrolled agent. So what we suggested, one of the criteria is if they're communicating to the IRS on behalf of the taxpayer with regard to their liabilities, their tax liabilities, and their privileges, that's an aspect of practicing before the IRS. Now, if the IRS asks you for information, if you simply provide information to the IRS, that's not practicing. So you see the difference from what we just suggested, right? We're going to talk about 4 key examples of what it means to be practicing before the IRS. But the first one, we said we're communicating on behalf of the taxpayer with regard to the taxpayer's liabilities and privileges in regard to the tax code. But now I'm saying, that being said, that if we provide information to the IRS, we're not practicing. So the IRS might ask us, let's say we're a manager for a particular company. So let's say that Camilla is our employee, and the IRS contacts us and says, you know what, send us the W-4 for your employee. So send us Sharon's W-4. What's a W-4? Right, the W-4 indicates your withholding. So that's your chance to indicate how many exemptions you expect to be able to claim at the end of the year. So if the IRS asks you, to provide that information, that's not practicing. Now, your company must have a policy about sharing this information, but if it's coming from the IRS, they should have it, but if for some reason they ask us to provide an additional copy of it, and we do that, then Camilla, don't worry. You're not practicing, that's not practicing before the IRS. You're just furnishing them with information. Or, for example, if they ask you to meet with them, just to talk with them, and they want to say, ask you a question like, when did they file the W-4? Or did your company take withholding from Sharon's paycheck? That's not practicing before the IRS. But if you're gonna be communicating with the IRS with regard to how much tax Sharon owes, if that's the nature of the discussion that you're going to be having with the IRS, then that's an example of practicing. Now, if Sharon, this is, I don't know if this is how this is going to turn out for you, but let's say there's some type of hearing. So the IRS has a hearing. They decide that they're going to audit Sharon, and so they're going to have a hearing. Basically, some type of meeting or conference, and you represent the taxpayer at that hearing, then that's an example of practicing. So you see the difference? We're going to go through a couple of more criteria, but you see the difference so far? Between furnishing them with information, that's passive. They gave me the W-4, and so you don't want it, I'm going to give it to you. Or they ask you some questions, you're testifying, that's not the same thing as practicing. But if you're going to represent the taxpayer, if you're at the conference, at the meeting, at this hearing, to represent the taxpayer and discuss the nature of their tax liability, or their deductions, or the nature of those deductions and their expenses that they've taken on Schedule A, well, then that's something different, right? You see the difference? Now you're representing the taxpayer in a professional capacity. You're not just sharing information, you're not just sharing documents, you're representing the taxpayer in a professional capacity. So you're speaking on behalf of the taxpayer. If, for example, we're going to prepare certain documents for the IRS and file them with the IRS on behalf of the taxpayer, then that's an example of practicing. So if we prepare the documents on behalf of the taxpayer, not just share information with the IRS, not just pass along documents, but in a professional capacity, as a CPA, as an enrolled agent, as an attorney, we prepare these documents and submit it on behalf of the taxpayer, then that's also an example of practicing before the IRS. If we give written advice, if we give the taxpayer advice in writing about what deductions, for example, they're eligible to take, and there's obviously going to be some implications in terms of what their tax liability would be, then that's an example of practicing. And we're going to see in a minute, we'll talk a little bit more about the nature of our obligation as it relates to the taxpayer. So right now we're talking about what are our professional responsibilities within the context of ethics. And so the first thing that we're addressing is aspects of Circular 230, which defines what it means to be practicing before the IRS. Are we good? Fabulous. So that was the first question. So remember, just preparing a tax return, just furnishing the IRS with information is not practicing. Anybody could do that. So you're like, well, wait a minute, even preparing a tax return? Anybody could do that. And the IRS has become more sensitive to that too. And that's why now you're required to have a PTIN number. You guys know what a PTIN tax number is? PTIN is a paid tax preparer identification number. And remember, yeah, I think we talked about this the first day. We said that doesn't give us any credentials. That doesn't mean we're qualified. That doesn't mean we're an enrolled agent or a CPA. Doesn't mean we passed any tests. It's just the IRS wants to keep track of those people that are getting paid to prepare taxes. So in of itself, preparing taxes is not practicing before the IRS. So there's students at the high school across the street. They prepare tax returns for people in the community. Yeah, they prepare tax returns. That's not practicing before the IRS. If we're acting in a professional capacity and representing the taxpayer before the IRS, like we said, at a hearing or at a conference, that would be an example of practicing before the IRS. So the first, so the question says, what is not an example of practicing? Well, the first one is not. That's not practicing before the IRS. It says preparing the tax return, furnishing information at the request of the IRS, or appearing as a witness for a taxpayer. That's not practicing before the IRS. So that's the correct answer, but we see why that's the correct answer? That's not what practicing before the IRS means according to Circular 230. But the other choices are examples of practicing before the IRS. Communicating with the IRS for a taxpayer regarding the taxpayer's rights, privileges, or tax liability. The other choice is preparing necessary documents and filing them with the IRS for the taxpayer. And in this case, they said when it's prepared by a different practitioner. So you're acting in a professional capacity and providing advice. And representing a taxpayer, like we said, at a conference, at a hearing. We're not a witness there. We're speaking on behalf of the taxpayer. We're representing them. Those are all examples of practicing before the IRS. Now the next question is interesting, because the next question asks, what is our responsibility as a tax preparer when the taxpayer asks for certain documents, asks us to provide certain documents to them? What is our responsibility? Now you say, well, why would that be an issue? Coach B, right? Why would that be an issue? What do you mean if they ask you for documents? Well, so we expect to get paid for preparing somebody's tax return. Okay? Elon?
Yep.
You want to get paid, right? So we're going to get paid to prepare somebody's tax return. But sometimes clients don't pay. Yep. I can tell you, sometimes clients don't pay. So what recourse do we have? Now the client might decide that, that they're not going to pay, but they ask you to provide for them their W-2. They say, you know something, I'm done. just give me my W-2 and I'm out of here. Now you already, maybe you spend a good amount of time preparing their return, and they owe you a fee, and they ask you to give them their W-2. Well, IRS and Congress expects that you will promptly provide documents that will otherwise prevent the taxpayer from filing their return. So what does that mean? So in other words, if you don't give them back their W-2, they're not going to be able to file their tax return. So the IRS says that if a situation arises where even if they owe you a fee, that's not grounds for you to hold on to, in this case, like in our example, their W-2. Because holding on to their W-2 means that they can't file their tax return because you're supposed to attach the W-2 to the 1040. The IRS says, look, we're not confused about this point. I know that you want your fee. We really don't care about that. We don't really care about that you want your fee. We're not even getting involved in that. Our expectation is that you will promptly, so what does promptly mean? They don't say 1 day, 2 days, but promptly, what do you guys think is prompt? You have a client, you prepare their tax return, they don't pay you, they say, I changed my mind, I'm gonna let Alam do it. You know, I'm gonna let Alam do it. So they say, give me back my W-2. Now, I know, let's not kid ourselves, I know that you are thinking, well, they haven't paid me. The only thing that would make them pay me is that I have their W-2. And the IRS says, no, we don't think that's appropriate. That's unethical. That shouldn't be part of the consideration. You should return to them the W-2, even if you didn't get paid. That's what this question addresses. That's our obligation. Unless there's some state law that that would come into play, the practitioner, us, the taxpayer, should provide the client with the W-2, regardless of whether we received our fee. So the next question has to do with Frank. He's a CPA. And in Circular 230, there's a section, Section 10 obviously, and you said, remember we talked about it, I said Section 10, what happened to the other sections? Well, Circular 230 only includes Section 10. There's literally like 900 other sections. But Section 10, paragraph 30, talks about how it is that we're going to be able to get clients. So what is it considered to be acceptable? That's what it says here. It talks about the following solicitations of employment. What does that mean? You're probably wondering, what does that mean? To follow solicitations of employment? That means, how are we going to get clients? So they want to know what is considered to be acceptable. And the next question is going to address this as well. So one of the choices is target mailings, communicating with a family member. Another is seeking new business from a former client. And in Circular 230, it says that, you know something? All of those are fine. So that's legal, that's lawful. but they suggest that if you are going to solicit the family members or it's part of a target mailing, that you should indicate where you got the information. So what's the source of the information that you used in choosing them to receive your postcard or your letter. So that's fine. That's right. That's okay. So far, we're not concerned, right? I haven't said anything crazy yet as far as how Congress is going to control our activities as tax preparers. Even you might think, well, that's really not so bad. I could communicate with family members. That's okay. Former clients, it's okay to reach out to them, send them a mailing. That's fine. Yeah, that's fine. We could do that. But then the next question, to give some more clarification. And one of the things that concerns Congress is if we make some claims about the quality of the service that we're going to provide. So if we say that we're the best, if we say Camilla is the best tax preparer, then there's got to be some way to substantiate that. So that's an example of something that we can't say in our postcard or our mailing. Now, we could indicate our name, our address, the office hours, the names of our associates, all that is fine, and any professional memberships. Like, for example, for myself, I'm a member of the AICPA. I'm a member of the National Association of Tax Preparers. I'm a member of the American Accounting Association. If you're members, if you're a tax preparer and you're members of those professional organizations, it's okay to indicate that. That's fine. Why do you think that somebody might not be okay with that? Why do you think that the Congress says, well, you know, we thought about that? That's what it says. It says we're okay with that, but that's because we thought about that issue already. Why do you think they even thought about that? Why would that matter? So if they say, Myles Bassell, AICPA member, National Association of Tax Preparers. What does that do for us as a tax preparer? Anything or nothing?
Gives you more credentials qualified.
Yeah, that's it. It gives, it adds some credentials. Now, Congress thought about it and they said, we're okay with that. In fact, one of the things that that the Board of Accountancy wants is that we engage in continual learning, ongoing. It's not just you pass the CPA. That's like, okay, well, that's impressive, but we want you to stay up to date. Like, so for example, these organizations, like the AICPA, I get an email from them every day with news bulletins. And it's very convenient to like focus on those news clips as opposed to, sitting down, like reading, an entire newspaper. So it's very targeted, things that interest me. So it keeps you aware of things that are going on in the industry, in the field of accounting, in the field of taxation. So they said, well, you know what, we understand how these professional organizations work, and if you are a member, and we know that part of that is that you're getting updates, and they send you newsletters, and they mail you magazines, right? You get the Journal of Accountancy. They said, well, that's fine, so why shouldn't you? Now, by the way, to be a member is not free. So there's a cost associated with that too. So for example, my membership for the National Association of Tax Preparers is almost $200. It was actually $183, something weird like that. AICPA is over $200. So yeah, there's an expense associated with that. Otherwise, like everybody would just go, why not? Why wouldn't I just put that down?
that's monthly?
Hmm?
That's monthly or annual? Yearly?
Annual, yeah.
Monthly is monthly.
So, but we need to be sensitive to that, because you know, as tax preparers, so remember, you don't need to prepare a tax return, you don't need to be a CPA. And that's why you heard a couple of weeks ago, the IRS took the PTIN system offline. Because right now, in the courts, there's an issue that's being fought out, because the IRS wants tax preparers to not only have the PTIN, which is just an identification number, but they want the tax preparers to pass a test.
I thought they didn't resolve that yet.
No, it's not resolved. Yeah. So Congress is trying to increase the, you know, the standards, raise the bar, so to speak, for tax preparers. So now as you're thinking about getting clients, right, you're taking courses in marketing, and you're taking courses in advertising and management, you might have all these creative ideas, but the guidelines and the requirements are different than if you're soliciting people to wash their windows. You want to wash windows? You could put out flyers that say, you're the best window washer in Canarsie. Nobody's going to bother you, nobody cares. But now if you said you're the best tax preparer in Brooklyn or some part of Brooklyn, the IRS says, well, you need to be able to substantiate that. And that actually is not just relevant to taxation. Even, for example, Oreo. They were put to the test. America's favorite cookie. America's favorite cookie. But then their competitors pushed back and says, where's the proof? What do you mean you're America's favorite cookie? That means you're the market share leader. Now either you could provide proof of that. Now if you have proof, if you have some market research that could show that you are the best tax preparer. Well, let's say if you claim that you get refunds faster than other tax preparers, or you could get more of a greater refund for your clients than other tax preparers. Of course, wouldn't you get a lot of clients? Sure. If he prepares, right? If you prepare the tax returns, of course their refunds are going to be greater, right? But how are we going to substantiate that? The Congress says, come on, that's ridiculous. The IRS code is the code. That's it. There shouldn't be any discussion about what deductions you could take. Why would, if you prepare the tax return, or Corinne prepares the tax return, the refund should be the same.
But a lot of the firms, they advertisement, we do the more refund, they're doing advertisement on the TV and radio.
So if they're saying that they're going to get you a greater refund than another tax preparer?
They provide the more refund like that, they say.
Well, then, so that's in violation of Circular 230. And Circular 230 talks about the guidelines for ethics and professionalism.
But Professor, certain tax preparers, they don't really go into detail to like look for those certain deductions that the taxpayer may qualify for. But others, they do their due diligence and make sure that they get the maximum deductions. And
Right. So how could you be in a position to say that you'll do it better than somebody else? Right. If somebody's entitled to certain deductions, then whether you prepare it or Camille prepares it, the refund should be the same. It should be the same deductions. That's the way the IRS views it. It's like they're actually concerned. Like, well, why would the return be any different? Why the return should be the same? Now, of course, there's people that they say, well, just put down that you gave. That's right. That you gave charity, right? That you gave charity. Of course, it was cash, so you don't have any, right? You don't have a canceled check. So you gave charity to 5 different charitable organizations. You gave them $50 each. Okay, then, you know, they'll tell you to do that. They'll say, yeah, just take that as a deduction, or any other. Think about, but like last time, we're talking about, you know, what happens if you have a casualty loss. Or what about if you have medical and dental expenses? You're not required to provide proof of those when you submit your 1040 with Schedule A. It's only afterwards when they come back and they'll say, yeah, we were looking at your return, and so we're just like really curious. Can you provide us with proof, right? We believe you, right? They say, we believe you, but you know what? I'm going to believe you a lot more if you show me that canceled check for $15,000 that you paid to Kings County Hospital. See, now we know that that happens. We know that the IRS knows that these things happen. And we have some obligations there too. The next question is going to address that about how it is that we could open ourselves up to a $1,000 penalty as a tax preparer. So if we have a reasonable belief or reason to believe that that deduction is not legitimate, then we could, at a minimum, be subject to a $1,000 penalty. But, you know, the thing is that people think they're not going to get caught. That's why these executives, why they do so many unethical things, is because they feel that they're not going to get caught. You don't think that they thought they were going to get caught, right? They thought they were going to get away with it. That's why they did it. And so the IRS says, you know something? If you're preparing the taxes for somebody, then you have responsibilities. You have an ethical obligation. If you knowingly prepare somebody's return and it includes deductions that that person is not entitled to, then at a minimum you're subject to a $1,000 penalty.
How would they prove it? I mean, you're going based on what the client is telling you. Like you said, they're not obligated to bring proof.
Right.
But you're just
So-
going by what the client is saying to you.
Right, so we should do some due diligence, like Muhammad is saying. We're not private investigators. Granted, we're not private investigators, you're right. If they say that, and the neighbor's kid lived with them, and they provided more than half the support for the neighbor's kid and so on, and they passed the residency test, they had the kid's social security card, we're not obligated to go out into the field. Yeah, I think is what you're saying, to go and ask the neighbor and say, do you agree that your son, this is your, you live with your neighbor? And I agree, we're not, but the IRS is also aware that these things do happen and that they're saying that you're going to be held accountable. Because at the end, remember we talked about, there's always finger pointing. So of course the taxpayer said, he told me, and the tax preparer says, he told me. They said, don't think that you could just, you know, encourage the taxpayer to take deductions that they're not entitled to and you're just going to walk away. No, you need to know that there is a law on the books that says that at a minimum you could have a $1,000 penalty. So again, I know the wheels are always turning. People are like, how would they know? Whenever we talk about legal things, how would they know? How are they going to find out? Because we're lucky like that. So the thing is that what Circular 230 is talking about is integrity. They said they may not know, but integrity is about doing what's right, even if nobody is watching. So our obligation, what Circular 230 is trying to impress upon us is that we have this ethical and legal obligation. This is our expectation of you. Will you get caught? You know, only actually, only like 1% of US taxpayers actually get audited. So the chances are that we won't, right? Any one of us wouldn't, right? The odds are actually in our favor, but that doesn't mean that it's the right thing to do. I know people who have been audited, and what's so ironic is that they were so like squeaky clean. It was ridiculous. Like everything, and I can tell you, between us, there was nothing. Everything was absolutely, totally legitimate. He had all the documentation, but to go through the process of the audit, he ended up hiring an attorney and also had to pay his CPA, and cost him more than $15,000. And at the end, you know what the IRS said? Thanks, we're not going to pursue this any further. You're not going to pursue this any further. I'm out 15 grand. So, yeah, it's better that you that you not get audited, because the proof is on us. The burden of proof is on us. The IRS just says, you just provide us the proof, right?
You're like,
They said, we believe you. We believe you. Just provide us all the proof. And we had all the proof, but it took a while to pull everything together.
That client just deduct that from his next year's return. That 15 grand.
That would be nice.
Legal fees.
That would be nice. All right, the next thing. So it all comes back to this issue of ethics. Do you talk about ethics like in all your courses? Because I know you probably get tired of hearing ethics, ethics, ethics.
Yeah.
But you know, the funny thing is, despite all that we talk about ethics, executives, whether in the accounting field or outside of accounting, do things that are unethical and illegal. And I'm just here to say that I, as your coach, as much as I'm here to support you and encourage you and help you to be successful, am not taking a trip to Rikers Island to visit any of you. None. Not even you. I'm not crossing that bridge and go there and say, oh, coach, circular 230. Yeah. Nope. No way, Jose. So just remember, I'll send you a postcard. All right. Now the next question. So we're clear on that, right? That you have to be careful about claims of quality of service if it can be verified. All right. The next question talks about a covered opinion. Now, the first, it says which one of these choices, in terms of providing a covered opinion, which must comply with each of the following requirements, except. Now the first one is just obviously not correct, because it says to base the opinion on unreasonable factual assumptions. Now, so you got to read these questions slowly. All right? Now, at first you might think, well, what's wrong with that? What do you mean? Base the opinion on unreasonable factual assumptions. Because you're so focused on factual that you miss the part where it says unreasonable. But what do you mean? Of course, it's got to be reasonable. So it says, except a covered opinion must comply with each of the following requirements, except base the opinion on an unreasonable factual assumption? Oh, no way. It has to be reasonable, and it's not just that it's reasonable, but it must relate to the law as well. So it's got to be based on facts and relate to the law. So the relevant facts have got to apply to the law. It's not just the facts in themselves is not enough. It's not just the facts by themselves. It's only that those facts are relevant to a particular part of the IRS code. And that's what also the next question addresses, as it talks about in question 6 about best practices. So, best practices include all of the following except, well, the reason why B is not correct, because it says establishing the facts and arriving at a conclusion. But the facts are only significant to the extent that it's relevant to a particular part of the IRS code. So that's not correct. So in Circular 230, in section 10, paragraph 33, talks about best practices. So what are the best practices? So for example, communicating with the client, the nature of the engagement. So in consulting, that's the term that we use, engagement. So basically, you could say project, whatever term that you feel comfortable with, assignment, job, but in the industry we use the term engagement. And so, in terms of best practices, we need to have done a thorough job in communicating the scope of the engagement with the client. And we need to act fairly and with integrity when we're practicing before the IRS. That's an example of a best practice. So what does that mean when we say fairly? That means that it's not just what's in the best interest of our client. Sometimes we need to say, you know what? You owe the IRS. That we need to give them advice that's going to actually be in favor of the IRS. It's not like in when you're a criminal attorney and you know the guy is guilty, but you get up there and defend him anyway. Circular 230 says, no, you're a professional. You need to be able to advise your client and say, this is a legitimate deduction. No, this is not. You need to, you owe the IRS. So you need to be fair, you need to be impartial. When we give them advice, we need to make sure that they understand the consequences of the advice that we give them. So if we tell them that they could take a certain deduction, they need to be aware of the implications. Like, for example, that 2.5 years after the fact, they might ask you for the canceled check. So that today, it's going to reduce your taxable income, but in 2.5 years, the IRS might ask you to provide proof. It's important that the client understand that. Not just that they got the deduction today, but to understand that, that they would need to have proof if they're audited by the IRS. And we said, what's the best type of proof? Yeah, a canceled check. What about an invoice? Right? An invoice is not proof. It's only, it only shows that you were billed. It doesn't show that you paid. Remember we talked about that, the difference? You could be billed for a lot of things. That doesn't mean that you paid. The IRS will allow you to take certain deductions for expenses that you paid. So if you have medical expenses, they said, yes, we understand you might have some medical or dental expenses. And if that's in excess of 7.5% of your adjusted gross income, then you could take that as a deduction. If you paid it, remember, if you have that check that you paid to Kings County Hospital, okay, that's fine. If it's more than 7.5% of your adjusted gross income. Now, if your healthcare provider paid that, if your insurance company paid that, then that's not something that you could deduct. Only the expenses that you paid. So, your insurance company might have paid $25,000. Well, we should be happy. But we can't take that as a deduction. Now, if out of that $25,000 we paid Right on top of that, let's say we had paid $5,000, then we'd have to see, is that $5,000 more or less than 7.5% of our AGI? So 7.5% is the floor. So that's the part that IRS expects, that we're going to pay the first 7.5% of our adjusted gross income to cover medical and dental expenses. Above that, you could take as a deduction. All right. Now the next question says, a tax advisor with which of the following responsibilities should take reasonable steps to ensure the firm's procedures for all members, associates, and employees are consistent with best practices? And the best answer is C, which is that the individual, the tax advisor, must both oversee the firm's practice of providing advice concerning federal tax issues and preparing or assisting in the preparation of submissions to the IRS. So it has to be both of those. So the best answer there is C. Now, what about if we employ some people to prepare taxes for us? Suppose we have our own firm and we hire 3 employees to prepare taxes for us. And they prepare the taxes, but then they're not there to sign the return. So you need to sign the return and present it to the taxpayer. So the tax preparer has got to sign the return and present it to the taxpayer. But what happens if, let's say, we have Karen, Camille, and Tanya that we hired for our office in Brooklyn. And let's say that Camille is out of the office for 2 weeks. So Camille is in Jamaica for 2 weeks, and Karen is out of the office for the day, but the taxpayer comes in. If it's a return that Camille had prepared, would Karen, and under what circumstance would Karen or Tanya, well, Karen, you're out of the office for the day, so you won't be able to do it. But Tanya's there, and Tanya calls up and she says, Coach, what do I do? Because the taxpayer is here, Camille is in Jamaica for 2 weeks, and Karen is out of the office for the day. Who could sign the return? Can Tanya sign the return for Camille? Let's say it was Camille's client. Could Tanya sign the return?
If she reviewed, she had reviewed the what you call it, the preparation, all the documents, and she got those. She wasn't part of the interview, but she reviewed everything. Yeah, then she could. Okay, so why? What would give if Tanya does like you're saying, which you're on the right track. So Tanya, one of the things that Tanya would need to do is she would need to review all the documentation. She would need to review the W-2. She would need to review the 1040 and go through and check everything to see that she agrees with it. But why is it that Tanya would be able to sign even though Camille was the one that prepared the return? Since she reviewed all the documents, and if everything is accurate.
Well, what about Karen? What about if it was Karen's client? Would Tanya be able to sign the return?
It'd be like if she's
Well, to some extent, I mean, once, it's a lot easier when somebody's already went through the calculations and filled out the forms, and we should be doing that anyway as part of a quality control process. And you want a seat right there? Yeah, take that seat. Take the, that's okay. We should be doing quality control anyway. Somebody should be checking the return after we prepare it. But there's a difference between Camille's situation and Karen's situation according to the IRS. What do they view as being the difference? Why would they say, if we do what you suggested, that Karen's return can be signed, right, the return that Karen prepared can be signed by Tanya if she reviews all the documentation and the actual return, the 1040, but not in Camille's case.
I think it's the time of absence,
Yes?
because one person is 1% up for the entire week, and the due date may fall within that week.
Well, so you're right. The fact is that Karen is not viewed as being unavailable. Karen's just out of the office for the day. The IRS says, well, Karen prepared the return. Wait till tomorrow. Now, Camille is not available. Camille is in Jamaica for 2 weeks. The IRS says, you know something? Tanya, you're there. If you review the return and the documentation, then you could sign the return because Camille is not available. Karen, they view as being available. See, so that's the difference between those situations that we described there. So for question 8, the answer is B in that scenario. That's what that whole XYZ thing is all about, right? Tax preparer X and Y and Z. So in our case, it's Camille, Karen, and Tanya. The issue, the point is, as relates to the regulation, is that Karen is considered to be available because she's going to be back the next day, and Camille is viewed as not being available. So the correct answer there is B. Now, here we go. This is, some of you can probably relate to this. So that being said, so if I'm employing these tax preparers, for example, or you're employing tax preparers, what is your obligation in terms of sharing that information with the IRS? So on the one hand, the IRS says that you need to, under section 6060, prepare a return that shares with the IRS the preparer's name, their identification number, their where they work. But then it also says that there's an alternative method. So what's the alternative method? The alternative method is that you keep that information available should the IRS ask for it. So really, you don't need to file that information with the IRS. They said that it's your option if you want to, but we'll also give you the flexibility that if you have these tax preparers preparing returns, keep a record of their contact information, where they work, their ID number, just in case we have questions. Because at some point, they might come back and they might say, well, really, why would you take that? Why would you take that deduction? I mean, you prepared the return for the taxpayer. What? Tell us, just tell us in your own words why you think that was reasonable. And either you can, or you can't, like Tamara was saying, right? Tamara was saying, oh, I'm not a private investigator. How do I know? I just know what they told me. So you could tell the IRS that this is what the client told me. I didn't go out to the house to do to find out. I didn't do a surveillance to find out if the kid really lives there. They said, the neighbor's kid lives with me. I provided support. So that's why the IRS wants that information, because they may come back. There may be an audit, and they're going to ask questions. And one of the things that they're going to ask is, if they're trying to determine whether or not you had a reasonable belief. You had a reason to believe that the information was true. So the answer there is D, that you keep the information on hand. It's an alternative method. We keep the information on hand, but we don't really need to submit that information to the IRS. But we should definitely keep it. We should definitely keep that information on hand.
But it's which one is false? That was kind of.
Okay, so it says which of the ones is false, so the answer is D, because it says information returns of income tax return preparers must be maintained by the preparer for 3 years. For 2 years. But actually, the statute is 3 years. So 2 years, probably if they're gonna audit you, it's gonna be like 2 years, 11 months. So 2 years is definitely, for this choice, is definitely not correct. So are the others correct?
What is B about? Because I didn't understand.
All right, so the period for which the information return is required is for a 12-month period. But, so in other words, during what period? So if you did do an information return, it's during a 12-month period that you capture that information. And then for the next 12-month period, then you might have different tax preparers that are working for you. Right, so it says through starting in July 1st, right, of each year. So you see why that is? Because just like when we're training students to prepare tax returns, people only think about April 15th. That's all people think about. But they don't realize that all the preparation that goes into training people and setting up the office to be able to prepare returns. Taxes is all year round. The due date is April 15th, but taxes are all year round.
Even for fiscal year agencies, the due date is different, so it is, the due date for 1040 is April, but like for corporations the due date is different, no? If they have fiscal year,
Right.
Fiscal year is different.
Right, so corporate tax returns are due on March 15th. But what Tamara was saying is, what's this issue about where it says that we have to provide the informational return is required for a 12-month period? Well, the 12-month period means that they're trying to capture the information for a 12-month period because that information can change. So that's one information return. Then for the next 12 months, maybe the information is the same. Maybe you have the same employees. If that's the case, then you just replicate that. But if it's different, then just provide any updates. So it's not just that what this is calling attention to is not that you just list all the, just on an ongoing basis, anybody that ever worked for you. It's no, within this 12-month period, who were the tax preparers and their information. All right, so more about the last question about the responsibilities for us as a tax preparer. So this addresses the issue of an understatement of tax liability. So that means we actually indicated that the taxpayer owed less than what they actually did. So remember before I was alluding to the fact that there's a penalty. So this question says that they'll be excused. Okay. It says that this taxpayer will be excused, the tax preparer will be excused if, and one of the choices says that the understatement was unintentional. Well, it's not a matter of whether it was unintentional or not, but what matters is whether or not there was a reasonable cause and good faith. So you, like I said, there was reason to believe that they were entitled to that deduction. So it's not a matter of whether it was intentional or unintentional. Well, obviously, it had to be intentional if you took it as, if you recommended to the client to take it as a deduction. But if you believe that it was the right thing, that's what is being addressed here. If there is an understatement of the tax liability, then we might avoid the penalty if there is a reasonable cause and good faith. So if we acted in good faith, you know, like Tamara's saying, I don't know, I feel a little uncomfortable, I only know what the taxpayer told me. Well, that's true, but that'll only get us so far, because the IRS feels that there often are situations where taxpayers are getting advice from tax preparers to take, for example, deductions that they're not entitled to. So you have to be convincing. You have to be able to convince them that, well, no, that you thought that they really were entitled to that deduction. All right, so that's an overview of Unit 1, which talks about ethics and professional responsibilities. And I hope you feel like that's left an impression on you, not just in terms of accounting or preparing taxes, but whatever you do in general in business. If you think about doing what's right even when nobody is looking, that's the approach that we should have. Very often we're under a lot of pressure when you have clients that are paying a lot of money. You know, so who wants to be the one to tell the client that they can't take that deduction? Or if you're doing an audit, for a client and you find something that you think is not appropriate, well, the client may be paying your firm $5 million. So there's definitely conflicts of interest. Look at, a great example of that is Enron and Arthur Andersen. They were getting paid millions of dollars from Enron. And so they worked together. See, the IRS is very sensitive to that and concerned about that. That they say, well, we just want what's fair. You know, where the code is what it is. You may agree or disagree, but that's the code. And as long as you pay what you owe, we're okay. We don't want any more. Don't pay us any more than what you owe. Just pay what you owe according to the code. That's what the law is. We're not expecting you to pay more than that. Just that. And we always, of course, as taxpayers feel that it's too much. But they said, we're not asking you to do more, just pay what you owe, and we'll feel fine. Just whatever's fair. Like the expectations of us is that we behave in a manner that's fair and demonstrates integrity. So be open with them, be fair, and we should expect the same from the IRS. All right, so ethics, professional responsibility, Circular 230, which actually is only 48 pages. I loaded it to our course website, so you could view that and the different parts. Now let's talk a little bit about the law and some of the legal issues that are faced by CPAs. And the focus for us is going to be on the Securities Act of 1933. Why is that date significant? So you're like, wait a minute, did you say, 1933 or 1993 or 2003? What, this is what we're going to talk about? This is your idea of like contemporary accounting? What do you, 1933? Why is that significant?
That, a lot of the laws were changed to protect, thank you, sir, investors when the market crashed in 1932.
Absolutely. So the Great Depression, that's at the time of the Great Depression in 1932. So Congress acted quickly after that and brought forth the Securities Act of 1933 and also 1934. And yes, we're still talking about it. It's still an act that's on the books and something that we need to adhere to. So the first question talks about the fact that this lady, her name is D, she has 12% of the shares of common stock. Now, think about it. When we go through these questions, sometimes they give too much information. That's on purpose. They tell us things we don't need to know. Like, for one thing, we don't need to know the lady's name, but there's also a lot of other information very often that is given. We need to decide what information is relevant to the problem. And in this case, the 12% is significant. Why is that?
Anything, if you have 10% or more, you are considered shareholder or significant, whatever the case.
Yeah, that if it's 10% or more, if you have 10% or more of the shares in a company, then you have a controlling interest. That's significant. So that part is important to us. So, and that being the case, if she is a controlling person, because she has 10% or more, in this case it's 12%, then she's considered to be an issuer. And the Securities Act of 1933 addresses that. What are the requirements for those that are considered to be issuers? Because most transactions actually are exempt from registration if it's between between two people, for example. So if I don't have 12%, if I don't even have 10%, and I want to sell my shares to Canal, then that's not a problem. But if we have a controlling interest, then that means that we're an issuer, which in this case is significant because that means that the shares that she's selling must be registered. So this question says if she decides to sell part of her holdings in year 9, then they must be registered. Now, if she wasn't an issuer, if she only had 5% ownership in the company, if she only had 5% ownership in the company and it wasn't a public offering, then she wouldn't need to register. But because she has 10% or more of the company, and she's a controlling person, then she's going to need to register. Now, the first thing says that, well, what about the fact that the company had registered the securities previously? That's irrelevant. All we're talking about now is the fact that D has these securities, right? She has these stocks, and she's going to sell them. But it just so happens she owns quite a bit of stock in this company. She has a controlling ownership. And now the company has made a public offering. And so the shares that she wants to sell are going to have to be registered. So specifically because she's a controlling owner and because a public offering was made. If there was no public offering, then it's probably she would be exempt from registering. But in this case, she's viewed as an issuer, as if she was the underwriter or the dealer.
So why doesn't it matter that the corporation registered the securities in year 2?
Because that's a part of a separate transaction. They registered the securities, she acquired, she has 12% of the shares. Now what we're focusing on is the fact that she's gonna sell some of the shares that she owns. So that's like, okay, that already happened, we know that. Now we're looking at today, here we have D, has 12% share of this company, and she's gonna sell some of her holdings. So now this is a new situation.
I think part of the reason why they require you to, an issuer to register is because that issuer may have some inside information which is leading them to sell those shares, so they just want to make sure that, like, you know, the other people, public is not being cheated on.
Well, we're going to talk a little bit about that next, about whether or not insider information is involved. So, for example, one of the things as it relates to insider information is that anybody could be guilty of insider information. It's not just the directors, it's not somebody that's on the board of directors, or, for example, somebody who is part of the management team, or maybe the administrative assistant to the vice president. It could be somebody that at the front desk that handles incoming calls for the company, somebody that works at the switchboard. If you receive information, inside information about a company, and even if you don't work for the company, right? So first of all, I want to dispel the myth that it's just the senior executives at the company. Very often we talk about that because very often those are some of the people that are involved in insider trading. But it doesn't need to be the CEO. Because remember, the insider, hopefully there's some type of internal controls where information is kept confidential, that everybody in the organization doesn't have access to this information. So usually it is, when you have issues involving insider information, it's usually a handful of people that had access to the information. But even if you don't work for the organization, if you receive a tip from somebody, so again, even if it wasn't the CEO, let's say it was his assistant who was photocopying documents, and she's doing her master's in business at Brooklyn College, and she looks at this and she says, wow, this is what Coach B explained to us in class. The stock of this company is going to go up. Oh, ethics, whatever. Stock is going to go up. The stock is going to go up 200% if this I'm going to tell my cousin. Well, then the person's cousin is guilty of insider trading, as well as the one who's giving the tip. So if you receive information, what we consider to be confidential information about an organization, then that's you're guilty of insider trading. So if you're the recipient of the information, one of the things that that got Martha Stewart into trouble, right? She was accused of insider trading, is that she got information about this firm, and she made some transactions, and she didn't work for the company. She wasn't like on their board, right? She's on boards of different companies, but not this company. Basically, her stockbroker gave her a tip that this stock is going to take off, right? Because they're coming out with, I forget what it was. It was either a new medical device or a new medicine, something like that. And I think as a result of that transaction, she made about $60,000. Now that might sound like a lot. This woman is a billionaire. So like, you're taking insider tips to make an extra $60,000? and you're a billionaire? Like, how much is enough? Like, really? Like, for $60,000? Well, anyway, so of course she got caught and, yeah. Fun times. So like I said, I'm not coming to Rikers. All right, so the next question is, let's see. All right, so it talks about offering. It says for an offering to be exempt under Regulation D of the Securities Act of 1933, Rules 505 and 506 each require that. Now, the first one is wrong. Who knows why? It says the SEC to be notified within 10 days of the first sale. So you have to fill out Form D. 10, it's not 10, it's 15, right? So it says that it has to be 15 days. So the first choice is wrong. And then choice C is also wrong because it says all accredited investors. Well, no, that's not true. It's only, right, it says all accredited investors receive the issuer's financial information. But actually, no, that's not true. Only the unaccredited investors receive the issuer's financial information. So that's not true. All the accredited investors? No. Only the unaccredited. And then D, it says there may be a maximum of 35 investors. 35 is the correct number, but the code says that you have to have a reasonable belief that it would be 35 investors. It doesn't say that's the maximum. It just says that you expect that it's going to be 35 investors. So it's a guideline. And what is the expectation? The expectation is merely that you reasonably expected that it would result in 35 investors. It doesn't say it's the maximum. It doesn't say you can't have more than 35 investors. It's not required. It just says that you're expecting that it won't be more than 35 investors. So, in order to be exempt, Regulation D, in order to be exempt, the code says that the offering must be made without the benefit of general solicitation or advertising. So that's B. The offering must be made without general advertising. Why is that? So, if you really expect that there's only going to be 35 investors, then isn't that kind of contradictory to say that, well, that you're doing this type of general advertising? Which means that you have a very broad advertising campaign to get investors. Well, that doesn't sound like you're only trying to get 35. So it says, if you want to be exempt, and you notify us within 15 days, and you expect that there's going to be less than 35 investors, then you have to do that without doing this general advertising campaign. Because if you do have a general advertising campaign, then they're not going to find that very believable that you were expecting to only get 35 investors. How is that possible? Unless you have somebody doing your advertising that's a bozo. Because I don't see how that's possible. So you took out an ad in the Wall Street Journal, and you really thought that you only get 35 investors out of that? So,
Can you turn away investors if you don't want?
yeah, you could. I think that you should turn away investors. You have to think. So what happens if you get the 37th investor, and they say, I'm going to give $1,000? You're like, why would I want to go there with the government? It's like, the guideline, right? It doesn't say that 35 is the maximum, but that's what's implied, right? That you expect that there won't be more than 35. So we could interpret that as meaning that that's what we should be aiming for. So if the 36th investor comes and says, I'll give you $50 million, then you might say, whoa, yeah, it's going to be hard to turn away the 36th investor. So even though it doesn't say that's the maximum, it's implied that there shouldn't be more than 35 investors. But if that's the case, if we want to be exempt, we want the offering to be exempt under Regulation D, then we should be able to do that without general advertising. Right? Just send an email blast to your classmates. Right? That should be enough. You should be able to get 35 investors that way. Or send to your professors. But if you're taking out an ad in the Wall Street Journal, then yeah, I would like to think that you would get more than 35 investors, and it's going to be hard to convince them, hard to convince the SEC that you only expected 35 to get 35 investors. So that means you wouldn't be exempt. Now the next question talks about which of the following conditions apply to private placement offerings. So under Regulation D of the Securities Act of 1933, which of the following conditions apply to private placement offerings? And the best answer is the securities B cannot be subject or be the subject of an immediate unregistered reoffering to the public. D is definitely, obviously wrong because it says must be sold to fewer than 20 non-accredited investors, which that's just not correct. In the Securities Act of 1933, it says very clearly that the limitation is 35 non-accredited investors. Okay, so that's definitely wrong. And C says must be sold only to accredited institutional investors, but that's not true. It's not limited to accredited institutional investors. It could be sold to accredited investors and also non-accredited investors. So the answer to 3 is B. All right, let's look at number 4 about this company called Bird Corp. So Bird Corp made a $5 million exempt common stock offering under Rule 505 of Regulation D of the Securities Act of 1933. The shares were restricted securities. As the issuer of the restricted securities, Bird must what? What's the best choice there? The best choice is A, make a reasonable effort to determine that purchasers are buying them for themselves and not for others. So you see what that is? That takes us back to the first couple of questions, which addresses whether or not we're buying as a financial institution or we're just an individual trying to sell our securities. Remember with D, we were trying to determine whether or not she was an issuer. That's relevant, whether or not she's an issuer. So here, what we're trying to find out is, with this question is, whether or not in this situation, if these are for personal investment. So we need to find out, we should make an effort to find out if they're underwriters. Or they're just purchasing for their own investment purchases. Right, for their own investment interests. Now the next question talks about a number of different forms. Let's see if we could identify what they are. So it says here, what form must be filed with the Securities and Exchange Commission by non-reporting and unseasoned issuers? So what is it? Which one of these forms? Yeah, S1. And now the key here, it says by non-reporting and unseasoned issuers. So non-reporting issuers is one that don't need to file reports. So a non-reporting issuer doesn't need to file a report. S3, Form S3 is used by seasoned and well-known seasoned issuers. So it's definitely not S3, because it says non-reporting and unseasoned issuers. S3 is for seasoned and well-known seasoned issuers. What about an 8K? What's the purpose of Form 8K? Quarterly is 10Q. Annual, 10K, which is the other choice. 10K is the annual report. So Form 10K is the annual report. So if you go to the website of a company, under the investor section, you could download the 10K, which is the annual report. But like Tanya's suggesting, they also issue quarterly reports, which is the 10Q. The 8K is used by an issuer to report current events. That's the 8K. All right, so remember we were talking about inside information. That's what this question addresses. Question 6. The SEC's anti-fraud rule, 10b-5, prohibits trading on the basis of inside information of a business corporation stock by. So what did we just say? It doesn't need to be the officers and the directors, the shareholders. It could be anyone. Anyone can be found guilty of insider trading if they use that information to trade. So D, the answer is D. So if you receive the tip, it's not just that you're the chairman or the director or the CEO or the senior vice president. It's not just that. If you receive the tip, then that's insider trading, right? If you receive a tip and you use that information to conduct trades, then that's an example of insider trading. All right, so let's talk about short swing profits. So there's a number of different time frames that are given here. It says, under the Securities Exchange Act of 1934, short swing profits arise from the sale and purchase, or the purchase and sale, of the issuer's stock within what period of time? Is it 3 months, 6 months, 9 months, 12 months? That's the choices that we have here. So what is it? What do we know? It's not something that we need to guess. It says in the Securities Exchange Act of 1934, is it 3 months, 6 months, 9 months, 12 months? What is it?
6.
Right? So basically it's 180 days, 6 months. So the answer is B. What is it that the SEC is concerned about there? What is it, this idea of like purchasing and then selling, or selling and then purchasing? What is it that they think is happening there? Why do they even mention that? What's their concern?
If they are holding on to some important information that is making them make that decision. Issuer if you're controlling share, you would know that information, but other outside parties won't.
Right, so they're concerned about insider trading. That's what they think is happening. They're thinking that if you sell shares, then what do? Well, what's our goal as an investor? We sell high and buy low. So of course, you know that you have privy to information about events that are going to occur in the future. And so, what are you going to do? You're going to sell your stock when it's high. And then what's going to happen? Well, maybe, 3 months later or 6 months later, when the stock goes down, you buy it back. That's what the concern is. That's what they think is happening here. And they said that 180 days, 6 months. Yeah, let's see. Let's see what happens in 6 months. 6 months they think is a reasonable period of time in terms of what they would define as short swing profits. A year, they're saying a year, we don't think that's a short swing profit. That could happen. I mean, you could be a CEO and sell stocks in the company that you work for, but within 6 months, they feel that would be an example of a short swing profit. That means we know that, especially, well, as an executive, you know that your business has some kind of seasonality or is subject to some type of cyclicality, so you're able to time the market. So they know that that's why they call it, this short swing profits, that the stock is going to go up, then you sell it, and then the stock is going to go down, right? And then you buy it back, and then the stock is going to go up, and then you sell it, and they're like, well, Renee doesn't have privy to that information. Yes? You want us to do your taxes?
No.
Professor, we could do it. You guys, right? Tell them that these guys could do your taxes.
Too late, my accountant had it.
Oh. I'm telling you,
We just lost a client.
free. They would do it for free.